So here is a 2023 real estate market forecast, or kind of an update, a forecast, if you will. And so as we're going to be talking about this, it's keep in mind that we're investors. You're going to be hearing a lot of things that might be kind of scary, not scary, like afraid, but like, oh my goodness, worrisome, but we're investors. So let's jump into it. So again, my name is Dustin Heiner, founder of Master Passive Income. The reason why I created this is because I quit my job and I had so many people asking me how to do it. And I thought, well, let me start teaching people. So I started teaching my friends and family and coworkers, people, friends from church, one-on-one. And then I realized I enjoyed doing that. I enjoyed teaching them. And it was a lot of work teaching one-on-one. And so that's when I wrote a book, did podcasts. It's just so much easier to give all this information out so everybody can get it. So that's me and my family. We went to Paris. We went on 2018 through 6 weeks, 11 different countries on a huge field trip. It was awesome. Okay, so the real estate market forecast, what we're going. Now, you could think about it right now. And one of my emails I sent out, it says, it's worse than 2008, meaning the real estate market and the economy is worse than 2008, or a different way to look at it, is it better than 2008? My perspective, depending on how you look on it, I'm an investor. Everybody that wrote in the chat, because you're here, you're an investor. We need to view 2008 as a window into what's going to happen 2022, 23, 24. I believe it's going to be better than 2008. Even though a lot of people are going to be hurt, it's going to be sad. But for us who are prepared, we're going to be doing fantastically well. So I believe it's better than 2008 for us as investors. Now, going through this, you might get discouraged or maybe even get depressed at what could be happening. But realize that this is what's going to have to happen. And it happened back in 2008. If you were, had anything in the market, if you had your own house, if you were working back in 2009 and 10, you would definitely have seen lots of people getting hurt. You might have gotten hurt yourself. Well, we got to be prepared for that. So don't get discouraged. In fact, even though these things can be discouraging, don't get discouraged. So this will be the best time ever. In 2010 was one of the best times. But right now, 2023 and 24 and 25 will be even better than that. That's what I believe. I am so excited for what's coming. All right. So what's been going on in all, like everything, not just the real estate market, but everything. Okay, let's talk about gold a little bit. So the price of gold so this is, you see a chart of gold, and we see in 1971, well, for forever, United States dollar was tied to the gold standard. 1971, Nixon took us off the gold standard. You could see gold started increasing in price. Now you can see it's right at the all-time high almost $2,000 an ounce for gold. So once we got off the gold standard, it just started going up and up and up. And we can see how it just keeps going up. Now, a lot of people are saying that it's also manipulated where the price should be higher than it is. Whatever the case may be, you can see the price of gold has just gone up and up and up. For me, I love gold. I love silver. I love real estate investing. I love tangible things, like even ammo and guns. Like those things are tangible. People will buy that stuff. If everything went bad, you'll be able to sell these types of things. So if you have the dollar, we know inflation, eventually that's not going to be worth as much as it is today. So let's keep going. So the price of gold is just skyrocketing, which it looks like it's going to keep going up because of all the inflation. Now, inflation, let's talk about that. So right now, if you look at the 40-year high right now, we're close to 10% inflation. And these are the government's numbers. This is what the government tells us. Right now, we're close to 10% inflation. Now, here's a really interesting thing. This was started getting me more like, oh my goodness, it might be worse than it is. So the government has changed how they actually, like right now it's 10%, but in the past, they actually changed how they calculate inflation and made it so that it accounts for less things, or it's calculated differently. So 1940, 1953, 1964, 1978, 87, 98, and 2018, all of these were times where the government changed how they viewed inflation. Now, if we're looking at inflation now at 9%, man, if you took into account, people have said, I didn't do any math, I'm not an economic major or anything like that. But if you calculate it back at like it was back in 1978, inflation would be like at least 15, if not more percent than that. So inflation is really destroying our dollar. Dollar is just a reserve note. It's the bank, the Federal Reserve, a note saying that they're guaranteeing that money. It's not gold. Gold is the standard that we should have, but we don't. Now, interest rates. This is something everybody's really seeing, especially if you're an investor right now. You're realizing, oh my goodness, interest rates are literally hurting me in my passive income. I know a lot of my students, we're even, a tip for everybody, when you're running your numbers, if you can get 6.5% right now from your bank, I would suggest running it at 7% because you never know if it's going to go up. You want to be protected on the higher side. So interest rates, we could see how right now in 2020, interest rates just plummeted. And then now they're going up. They're on their way up. If you can see down here at the bottom right-hand corner, 2020, it's going up right now. So we can see Federal Reserve from 2020, they have increased it a number of times. Like each one of those little steps is another rate increase that they've done. So the Federal Reserve raising interest rates, a lot of people think, oh my goodness, that's bad it is bad for a lot of people, but not for us as investors. I'm actually very excited that these interest rates are going up because what that does is it prices our competition out of the market. See, now we're not competition. Everybody on this call, we're not competition. We're investors. Now, we're investors. We buy it then lower than market value. That's how we capture equity. But who are our competition? Home buyers. Home buyers are the ones that get so excited. Oh, I love this house. I love the way this looks. I'm going to pay 10% more than it's worth. Like, we don't do that as investors. At least we shouldn't. I'm telling you, don't do that. If you've been a part of anything that I'm telling you, do not overpay for properties because we want passive income. So we're looking at interest rates going up. Now, on top of that, interest rates are going to continue to go up. Federal Reserve is saying it's going to go up even more in January. So they just increase the rate again. In January, they're going to increase it again. And I believe in February, they're going to increase it again. But they're going to kind of taper off. It might level off, but it's still going to keep going up. If inflation keeps going like they see it going, they might continually increasing the interest rate, which will affect the mortgage rates. Interest rates from the Federal Reserve always affects the mortgage rates eventually. It's not like a 1-for-1, but it always affects it. On top of that, so we have all these other things, and then we have the United States debt. The debt in America is getting crazy. Okay, so I cut this off so you can see like how dramatically crazy this is. So our debt, what is that, $4 trillion that we had back in 2000? Then now we're at literally, I pulled up the calculator. It's like the usdebtclock.org. We're at literally $31 trillion, $31.5 trillion of debt. And look at this. I mean, it's exponential, like right here, and then hitting 2020. What in the world? It is just going crazy. And if you think back in 2008, we had problems. Well, 2008, we didn't have nearly as much debt as we had. And those little gray bars, those are when there was a time of recession. And then the debt also, we're giving out money, plus we're also having another thing. This is the debt held by the government. They call it public debt. But if you could see the GDP, the gross domestic product of America, this is a percentage of the gross domestic product. So back in, was it 1900s, almost 1920, we were like 1-for-1, like a gross domestic product. We weren't over, we were actually, not going into debt. But then all of a sudden it starts taking off. And World War II, we're 100% above our gross domestic product. Now we're literally at 200%. It's getting worse and worse. And so what we're looking at by 2040, we're probably going to be at 200% because we just keep spending money. Our government does. So here's 2 hours ago, I took a screenshot of this. This is the US debt clock. So we have so much debt on hand, which means there's so much extra dollars out there that inflation is just going to keep getting worse and worse and worse, in my opinion. In fact, I think Biden just said he's going to give like $40 billion to South America or South Africa or Africa in general. I'm like, wow, that's a lot of money that we're giving away. Let's just add more numbers onto here. It's not looking very good for us. Also, on top of that, the printing of money. So all these, the reason I'm bringing up all these things, these are leading up to a potentially big problem here in America for most people, not for us as investors. If we're wise, we're going to be doing very, very well. So the printing of money, they call it quantitative easing. Now, the Federal Reserve printing of money. So they print money and just dump it into the system. And so that's what caused inflation, is they print more money to make the value of everything go in sense where they say up, but in what it really comes down to, your dollar doesn't go nearly as far. So every arrow is where they did a quantitative easing, which means they printed more money. Now, this last one over on the far right here, that they didn't say that they were doing quantitative easing, but this is what the Federal Reserve says is their balance sheet. I know this is kind of getting a little more technical, but really what it comes down to is the Federal Reserve is a bank and they're lending the United States money, is really what it boiled everything down. At least this is how I understand it. I could be wrong, but they now are at, look, it just skyrocketed, even though they said they were not doing quantitative easing. So with that, this is their balance sheet, and it just keeps going up and up over time. On top of that, what we see with the stock market, whenever they print money, so you can see the blue is the S&P 500. S&P 500 is going down in 2008. Remember, this is the stock market was crashing. You have Lehman Brothers going under, Bear Stearns, like all these companies were going under. Well, they started printing money, and they've been printing money ever since then. And you could see reason why stock market went back up. They basically started printing money, started giving them to the banks and giving to these companies. And that's why these values started going up. So we're printing more money. That's why inflation's skyrocketing on top of that. Also, mortgage rates. Remember, the Federal Reserve rate that they've set, which is bank-to-bank mortgages, not mortgages, loaning, bank-to-bank rates, eventually affects the mortgage rates, which affects us and home buyers. So the mortgage rate right now, you could see, and this was July, this is the most recent information. They don't have it completely, it's a little lagging, it's a little behind. So right now we're looking at probably around 6.5%, maybe even as high as 7%, but you can see it's dramatically gone up. Mortgage rates gone up just like with the Federal Reserve rates as well. Now, we might be thinking, man, 7%, that's a lot, especially we've been so used to 2% and 3% for so long. Well, my parents, I remember when they had 17, like look at 1982. That's like, I think it was like 17.5%. My parents literally had a mortgage. It was like 16 or 17% interest rate. Imagine how that would affect your cash flow if you bought a property with that, or if you're trying to buy a house, that interest rate. So what's happening as interest rates are going up, I'm not saying that they absolutely will. It just shows that Federal Reserves, they are increasing the rate, their interest rate between banks, which will affect our mortgage rates, which means mortgage rates should continue to go up. Maybe not as much, but it should go up. If inflation keeps going up, that's what the Federal Reserve is trying to, put off inflation. By doing that, they are trying to get rid of inflation by raising interest rates, which then hurts the economy. So they're going to basically, and I've heard a lot of smart people say this, they're going to crash the economy in order to stop inflation. And there's a couple more charts I'm going to show you where after a crash, that's when deflation comes because people don't have money, so prices come down. But 17%, it's been as high as that in most recent years. So here is the very most recent interest rate that I got. I would think it was on Redfin or something like that, or mortgage company, whatever. And the average nationwide is 6.31 for a 30-year fixed loan. Wow, man, that's pretty high, especially just a year ago. It was like 2.5%. That's a dramatic difference. Now, I want to show you this. Now, the reason why prices have skyrocketed so much in the recent years is because of the interest rates and a number of other factors that go into it. But a big one is interest rates. Okay, so let's say somebody, Joe Smith, he's got $1,800 a month to pay for either mortgage or rent. Well, if you look right here, he could technically afford a $400,000 house with a 3% interest rate because his payment would go that far. Well, as interest rates go up, what can he afford? Or he can't afford the $400,000 anymore. The $1,800 doesn't just magically go up to $2,600 or almost $2,700. So he can no longer afford the $400,000. He can only afford the $250,000 house. That's why homes are staying in the market longer, because the home buyers, people that want to live in homes, they're now priced out of the market because interest rates are so high. So this is showing us that prices should come down, and we'll even see that homes are staying on the market even longer. Now, housing market inventory. Now, realtors, we kind of listen to realtors, but we're investors. Realtors, they just like to sell houses. They're great and all, don't get me wrong, but as an investor, we look at everything from an investor viewpoint. I have a really good friend. He's a realtor, and he was telling me like a year ago, "Oh man, Dustin, you better buy a house," because we wanted to move into a new house. "You better buy a house now, or you're never going to be able to do that. It's going to be you're going to be priced out of the market." And I said, "You know what? I heard that back in 2007, 2008, and I did buy a house, and I got pinched, meaning I bought too much, and it crashed on me, and it was bad. And so I'm not going to do that again. So anytime a realtor is telling me I better buy, that's when I don't. Anytime a realtor is telling me I better sell, I don't. I don't do what they tell me. I do what I know as an investor." Okay, so housing market inventory. So this is nationwide. Nationwide inventory has jumped up in a year from 850,000 properties for sale to 1.22 million homes for sale. This is nationwide. That is a lot more inventory, because realtors will tell you it's inventory. Low inventory, supply and demand. That's why prices go up. That's not necessarily true. Now, let's look at in Phoenix. In Phoenix, it's literally, what is that? It was 4,000 back in January. Now it's literally 18,000. That is a dramatic increase in inventory. So with that, again, I agree with supply and demand. There's so much more supply, which means, and not as much demand, which means prices are going to come down. Now, housing average price. So here's the average price, and the most recent was like, I think 2021. So you can see the dramatic increase. Let's see. Oh, there we go. The dramatic increase in home price. It literally jumped from 2020. I want to say it's like 25%, maybe even 30% increase in price. And I'm going to tell you, if it jumps that much, more than likely, if there's a correction, which it seems like there will be, it's going to be just as much, if not worse, on the way back down. Now, the market summary, you can see median home prices. Now, for year over year, that's Y over Y. So here, the median list prices, YOY is year over year. So in the entire United States, it's up 11%. But now you're also seeing homes on the market 56 days, which is 15% longer than it had in the past. What's going on now is you're seeing prices are still stabilizing or staying high because sellers are notorious. They're nostalgic. They're thinking, man, 8 months ago, I could have got, 20% more than I can now. Well, that's why homes stay on the market longer. It's because they're trying to hold out for that higher price. Now, there's other things that are going on. So the stock market is similar to the Great Depression. As he's talking about, maybe I could just kind of skip through it. So this is back in 1995 down to 2002. So you can see the S&P 500, which is kind of, you see the arrows go up, down, and then all the way up. So this is the roaring 20s into the Great Depression. Very exact similar thing. This is a Dow Jones Industrial Average, which was the normal, or like the average for the day. Now it's the S&P 500. Same exact type of thing, up, down. They call it, I can't remember what they called it, but anyways, shoots right up. But then you can see, let's see, go. So here is the Great Depression. So you can see what the S&P 500 is, where it's at now. It dropped, but now you can see, now we had a drop, a little bounce up, and then down. This is the Great Depression all the way down here. I'm not saying this is what's going to happen, but this guy is much smarter than me. And he's saying that this is looking eerily similar. What we're looking at now, it looks like it can be another Great Depression all over again. So he also says that the S&P in 2023 could drop by 25%. If you could look at right here, we're at 4,000 right now. He's saying it could even come down to $3,000 for the S&P 500, which means a lot of stocks really, really get hit. He's saying that's like almost the minimum. It'll probably come down even more. So there's a lot of turmoil, other things going on. So you have Bitcoin crashing. You have in 2018, it was at $4,000. And in 2 years, in December, it's at $68,000. And a year later, $16,000. Like, oh my goodness, what's going on? That's a roller coaster. Now, I do kind of like Bitcoin, but at the same time, this is crazy. This is really, really crazy. Other things going on, China and nuclear war. So this is really interesting. China signs a $50 billion deal with oil with Saudi Arabia. Let me share with you my screen. I'm going to share another screen that has all this stuff. So, here's the US debt clock. Like I told you, it's still going. We're spend a lot of money. So here is China. They sign a $50 billion investing deal with Saudi Arabia. So now Americans, we've got off the gold standard, but what happened after that? We went on to the oil standard, basically, meaning our dollar was tied to oil. Now it's actually going to be coming to an end. It seems like it's going to get worse. So with the yuan, that's the Chinese quote unquote dollar, but that's their currency, $50 billion investment. This is just the start. So people are going to start buying oil in yuan as opposed to the dollar, which is a bad sign. Another thing is Putin is now talking about being okay with using nuclear missiles. I mean, this is just it's not looking good. Let me show you one other thing. And remember, this kind of gets depressing, but it's going to get better because it's going to be the best time for us to invest. Now, there's other things going on. Look at all these companies. Actually, let me go back up. These are companies that are currently laying off people. Like this is December. So this is just a laundry list of, and I can go through like Morgan Stanley, 1,600 people they're laying off. Let's see, this company, 18%, Airtable. Like I'm not going to go through them all. You can just see laundry list of like Alphabet, Google, 10,000 people they're laying off. They're currently doing that now. So this is a list. Amazon, 10,000 people to be laid off. Twitter, obviously, we know they're doing some shakeup there. Lots and lots of companies literally laying off, like Google or Facebook, 11,000 people. More layoffs here. This is even other companies that are not on this other site. So we're looking at there is a good amount of stuff going on that is really concerning for us as regular people, but as investors, it's going to be better for us. Expecting massive layoffs too. So I would literally today, I did a Google search. I pulled up my phone and I just typed in Google and I was just about ready to type anything like real estate market or something. But I looked at, this is what it said, top trending search was mass layoffs. I'm like, oh my goodness, people are even concerned about that. There's a lot going on. So things don't seem to be that bad right now. Like where you are right now, it doesn't seem like people like the sky's falling. It doesn't seem like that. Well, I like the TV show Psych. And the main character always says, wait for it. We're going to wait for it. This is what happened in 2008. I remember seeing this. Everything was happy. Everybody was great. 2008. Then everything crashed. So I'm going to go through these headlines really quick. Wall Street Journal's, the stock markets plummet. More New York Times plummeting, talking about the crisis. More and more and more and more and more and more. So many headlines come so rapidly when everybody starts realizing the crash is in. They don't think it's there yet, or at least you'll know when it's time to start investing when you start seeing this. When you start seeing this, be ready, but get your antenna up. Like, man, this might be the fantastic time to invest because prices are going to plummet down. For us as investors, it's going to be even better. Now, in 2008, it was amazing for us as investors because prices, like I bought from 2009 to 2014, about 17 properties. And usually, all of them were 50% off of the actual high of 2008. I mean, can you believe that? So I'm hoping it happens again, which I will be buying even more properties. Now, this is what has been going on, but I want to walk you through how to be prepared for the best time ever to invest. Now, remember, even though that was all bummer stuff, I'm excited. Charles is excited. William's excited. We're all excited to invest. And so if you're ready, you're going to be in a great position. Now, how to prepare. Very simple things, just to start, very simple things. Increase your income, get a side job, get a side hustle, try to get a raise, buy an income producing property. Like you want to start making more money. The more money that you have, the more money that you can use to buy more real estate. Save as much as you can, save dollars, even though it's inflating, maybe gold, silver, physical goods that you can actually sell. Be thinking about that type of thing. You want to start saving now. Don't go into debt. Don't get worse into debt. Now, if you do have debt, do not pay it. Like don't pay off your home right away. If you have a credit card that's 25%, pay that off. But if you have a home that's 3%, why pay it off when inflation is 10%? You're literally making money by having the bank lend you money. So I think you should not pay off those low interest rates now, because if you try to get another home to buy as an investment, you're going to be paying 7, 8, 9%. It'd be great if you had it as 3.5%. So my suggestion, at least what's what I'm doing, how to prepare is I'm not paying off my homes. All my properties that I have, I'm not paying them off faster. Now, I'm not going to give you advice to do this. I'm going to tell you what I did. I got out of the stock market, even though, like I said, that Gareth Soloway, he helps me to do trading. It's called swing trading. So it's like buy and sell up and down, but it's not buy and hold. Like my dad, sadly, he's so stubborn. Said, "Hey, Dad, it looks like the economy's going to change." He's all, "I'm fine. I leave it in there. That's just all I do." I'm like, "Dad, you got to change." Anyways, I sold all the stuff that's buy and hold. Now I'm shorting the market because I see it coming down. So, but you need to do what's best for you. Also, this is a big one. Get access to capital. You want private money. You want your home equity line of credit. If you refinance your home now, home equity line of credit is probably one of the best things because you're going to have access to that capital. You're not going to get interest on it until you actually spend it to buy a property. A business line of credit. That is a fantastic way to get access to capital. You want money so that you can buy the next property. Now, when you see all those headlines of everything going down, banks are not going to want to lend. In fact, that's what happens. Banks, they stop lending because they realize the economy is going bad. This person might lose their job, so why would we lend them money? You want to have this access now before everything goes bad. Once everything goes bad, if you have access to it, hopefully you're not going to take it away from you. It's going to be harder to get it once everything goes bad. Now, also, and this part of the presentation, I had a little fun. Actually, I spent a little too much time looking at surfing pictures. Anyways, you want to learn how to invest, and it's like learning how to surf. Now, basically what it comes down to, if you're going to surf, surfing a wave, you don't want to paddle after the wave passes you to try to catch it. Just like real estate investing, we want to be ready before the wave comes so we can ride that wave. So like, you don't want to be like this guy right here. This is why I said I had a lot of fun with this stuff. You don't want to be like this guy. He doesn't know how to surf. And he's literally, I just laugh every time. My kids were laughing at it too. But you don't want to be like this when it comes to real estate investing because you can get hurt. Now, another one. Here's another fun. Imagine you start paddling after the wave is already there. This guy gets hurt. Look at that. Ouch. But he wasn't ready. He started paddling way too late. He should have been already surfing at this point. If we're not ready, when the wave comes, we're going to get trashed like this. I got to watch one more time. His leg gets yanked. Oh man, that's horrible. All right. And not investing for passive income. Let's say you almost catch a wave, but if you're not investing for passive income, you're going to get trashed just like this guy because he wasn't doing it the right way. And here's another fun one. My kids just died laughing at this one. If you do not build the business first, it's like catching the wave. You're surfing, then bam, you get jacked upside the head. And with that, you think you have a good running business or you have an investment property that's making you money, but you're not doing it right. You don't have a business that's running and you get hit upside the head by, a furnace goes out or the roof goes, something, your property manager, leaves, whatever it might be. We need to be prepared, man. We need to build the business first. I got to watch one more time. Boom, right in the head. All right. So we'll go on. Now, learning how to invest the right way in this surf analogy. So we need to learn how to surf before the wave comes and we need to paddle. Like watch this guy, like he's paddling to catch that wave. That's what we need to do. We need to be prepared before that wave comes. Once that wave comes, we can catch it and ride that wave. On top of that, we build the business so when we do catch it, we can continually ride that wave over and over again. We build a business. I'll talk more about this in just a second. Also, we invest for passive income. This shot was just amazing. We invest for passive income so that it keeps making money over and over and over and over again. It'll keep going. We do not invest for appreciation. In fact, if you're investing for appreciation, like if you bought last year thinking, I'm going to invest for appreciation and hoping it's going to go up, well, it's going to come down. It absolutely is going to come down. Next one is we need to be doing our business. We need to build our business so your business works for you. You can literally just sit back and ride this wave in because your business is doing all the people that you hired, the experts on the ground. They're the ones that are going to be doing the work for you. They're going to make sure you're buying the right property, not buying one that, they're get shot when they go into. So we need to surf right and build the business and invest right. Now, how do we capitalize? How do we make money? How do we make sure that we make the most out of this recession? And I'll tell you, I'm so excited. This is going to be the best time ever for any of us. It's not going to come again. I don't think it's going to come again unless something crazy happens It might be like 30 years before it happens again. If you remember the Great Depression, the people that had money, they can buy almost anything. Well, if it happens again, we want to be ready. So we need to ride the real estate wave. So first one is we build the business first. We build the business first. So we have experts that are there to run the business for us successfully. Next one, we buy properties for monthly passive income. You guys hear me talk about that all the time. Monthly passive income every single month. We want to have monthly passive income, and we do not buy for appreciation. In fact, the people that were buying for appreciation back in 2008, they literally went bankrupt. And I've interviewed a lot of people on my show that have said, man, in 2008, I went bankrupt. I'm like, well, why did you go bankrupt? Well, because I got over leveraged and I was hoping for appreciation. I'm like, I know exactly. That's why we don't invest for appreciation. Appreciation is nice, but we don't invest for that. We also utilize other people's money to invest, which is one of the best ways to invest in real estate. On top of that, we scale the business. When we build a business, we can scale it because we already have a business that actually runs itself. And all we got to do is buy another piece of inventory and put it into our business. Now, I'm going to give you quickly the 3 secrets of real estate investing. I'm going to go through these pretty quick. A lot of you guys probably heard this on the podcast and everything, but you can invest in real estate with in your spare time with a full-time job. I literally did that. I even had a business. I had my kids and I had my full-time job and I invested in real estate. So we build the business. We find agents. We get contractors, we get property managers to find good tenants. We get software that collects rent, so the property managers do it. We do it all over and over again. And we have other people do all the work for us. But when you don't have a business, it's not automatic and you're answering calls. It's not efficient. You're probably potentially losing money. You're hoping to get to good tenants and praying that the rents come in. When I first started, I had rents not come in and it was horrible. Now, because I have it set up, we do it right. Step 1 is create a team of professionals to do the work for you. Property managers, contractors, realtors, plumbers, inspectors, roofers, mortgage brokers, all these sort of things. We build the automatic business around us so that it runs itself. And then we just get out of the way and let them do all the work. That's the big secret. Is a lot of people think they have to do so much work. Charles, William, and myself will definitely attest to, we do very little. Obviously, we're going to do some work, but the people who do all the work are the experts. Secret number 2, you can buy properties with no money down. Like you absolutely can. Let me quickly give you a couple of good ones. Seller financing, subject to in the recession is going to be amazing. People sadly will lose their homes, but they're still going to have great mortgages, like let's say 2 or 3%. Well, if you take over that property subject to that conditional mortgage that they already have, or that mortgage, conventional mortgage, then you have that property. It's awesome. We can go into that more. As you have questions, go ahead and write them in the chat. Charles is going to be watching over those so we can go through some questions. Private money. Love private money. Charles is an expert at private money. So you definitely want to talk with him too about private money. Home equity, use your home equity. Business line of credit. That's why we build the business first. We build the business so that business can get credit so we can buy more properties. Self-directed 401k or IRA, we do that all the time. All my students, we do this all the time. In fact, I cashed out my 401k because I make so much more money not putting in a 401k. House hacking, another great way, but we can do with a little no money. Also, secret number 3, it's an automatic business that anyone can do. Let me give you quickly what you do. You work one time, you get paid over and over again. You buy one rental property, then you get other people to fund it, other people to manage it, other people to find the tenants, collect the rents, do all that stuff. And then you just basically collect everything and pay out the bills and you keep the difference. That's what we do. Quickly give you 4 steps to passive income. Build the business, have experts run it for you, get qualified tenants making you $250 more or more for every single property. It's step number 3. Last one is you just collect the passive income every single month. Now, here's the forecast. This is what I'm seeing for 2023. Not getting into 2024 because it's going to be crazy to think of 2024 because of everything going on. So, number 1, investors will make a lot of money in 2023 and beyond, but you need to be prepared. Homes stay on the market longer as sellers hold out for more money. So see that right now, like the average is 52 days. 54 days, 52 days, one of the two. But you'll see it's going to go on even longer and prices will drop because sellers are not selling their homes because nobody's buying them. Another forecast. Inventory in the market will continue to increase. Like you saw, it went from, I think it was like 800,000 to 1.2 million. It might go up to 1.5 million or maybe even more than that. I see it going up because interest rates being so high, home buyers are priced out of the market. The economy will also have lots of problems on top of the real estate. You saw all the people being laid off. You saw the inflation. You saw interest rates. So many things are coming up in ahead, and it's worse than 2008 all over again. It's going to be great for us. Prices, here's my big prediction. I think it's going to come down 20% in 2023. So these homes, and remember, we're investors. We never pay top dollar. Prices are going to come down 20% in 2023. Interest rates are going to keep going up. But I think in 20% I'm going to say at minimum, I think it's probably going to come down even more. Interest rates will get as high as 8%, if not even higher than that. And if you are ready, you're going to make lots and lots of money. Now, we've covered a lot of things, but there's so much more that we need to look at. Everything from finding an area of the country to invest, what a good property looks like, know what to look for so you don't lose money, you don't buy a money pit, how to get financing. We know 15, 18 different ways to get financing, how to manage the property, so many other things that we need to do. So before we jump into the questions, so remember, everybody, type in your questions in the chat. Let me go through this. And so Charles will start curating all the comments and the chats. But I want to talk to you guys about the real estate wealth builders. And because it's Christmas time and because you're here, you're part of Master Passive Income, I'm going to give you guys a huge deal. Like it's literally huge. I'm really happy I'm able to do this. So here's what you're going to get. You're going to get the ultimate real estate investing system. That's the master class. That's literally like shows you how to build a business to owning real estate from step one all the way to the very end. That's a $3,000 value. You're also going to get another course I created, Your First Investment Financial Education. You're going to get that as well. That's a $700. That's why I sell these for right now. It's a total value of $3,700. Also the real estate foundations on top of that. I sell that right now for $500. You're going to get all three of those. That's a total cost of $4,200. The out-of-state investing, how to successfully invest out of state, that's $1,000 cost. So the ultimate real estate investing system, $3,000. Your First Investment course, $700. Real estate foundations course, $500. The out-of-state investor course, $1,000. Total cost $7,200. I literally sell you right now. Another one, advanced investor. I'll go these a little bit faster. The advanced investor course, that's a $1,500 value as well right now. If you bought it right now, I'm currently creating an Airbnb course. And so it's going to be a way that you use your homes also as a short-term rental property. That's going to be $1,000. So you get all these courses. And I also am going to be doing group coaching. So let me keep going through this. Sorry, I don't want to take up too much of your time. So with this, you're going to get group coaching with me. You come on the call just like this. And in fact, more. You have so many more people on asking questions, learning from other people. Private discussion group, deal alerts. You also get questions answered with a team like Charles and William and myself, mastermind with other students. Let me quickly go through this. Man, I guess I got too much. So I'm going to give you some bonuses too. I'm not going to go through this. It's taking too much time, but I'll give you some bonuses. This you're going to get a 7-week bonus. How to get your first property in 7 weeks. Let me go through this a little faster. $14,000. You could buy this right now. $14,000. Tools and downloads, all the forms, all the calculators, all the worksheets. $1,000 value. Total value $15,000. I'll get one more. Expert interviews. I've literally hired people to interview them so I can give them to you guys. $5,000 value. So I'm going to give you all these great things from tax experts to lawyers and planning and legal planning, all that stuff, all these things. And let me see, I think I have, you're not going to pay that today. Yes. If this course and this membership, all I did was make you $250 a month in passive income, built the business, an automatic business to help you get out of debt and actually make money. It's going to change your life. See, like I said, I sell these courses literally right now. These are the prices right now. You can buy them right now. Here's the ultimate real estate investing system. I'm going to give you all of these. Total values over $20,000. Literally, you can buy them right now. But here's what it is. If you go to this link. Actually, Charles, can you type in the chat, masterpassiveincome.com/2023. And instead of, so it's $800 to join and then $249 a month. I'm going to give it to you. I'm going to give you $700 off as a Christmas present. And for being here on the webinar, it's only going to be $99 to join and $219 a month. after that. I mean, shoot, you just stay in there, 4 months, and it barely pays for the joint fee. So you're going to get all of these things. Use the promo code 2023. So I'm going to leave this up here. Oh, you're going to get some bonuses there. Oh yeah, I guess I'm going to give you even more bonuses. There we go. Okay, so all this value, I just want to see you invest in real estate. So go to masterpassiveincome.com/2023. Use a promo code 2023 or 2023, and you will be able to get everything, and you'll get $700 off the joint fee. And in fact, I'm raising the price at the beginning of the year. It should be either $8.99 or $9.99. So I'm going to raise it up, and it's going to be $2.99 a month. So even that, you're winning there. But we already have, I mean, almost 100 students in there, literally helping each other out. We're asking each other's questions. You have all the coaches like Charles, William, and myself. We're all in there helping each other out. Okay, so I'm going to leave this up for a little bit. Charles, what questions are people asking, and how can I help people?
All right, Dustin. So we've got some good questions in the chat. It looks like some people send the questions directly to me as well. So Alexander has a question about using a 0% APR card for liquidity. Alexander?
Okay, so a couple things. When you get more credit, it actually helps you in the long run. Initially, it doesn't, because it's a ding, they check your credit and, oh, you had a credit pulled. But in the long run, if you don't close it, what's going to happen is you're going to get better credit because you have more actual line of credit, like ability to borrow, but you're not borrowing it. So it's going to help you in the long run. So keep that in mind on top of that. Now, here's my suggestion. I personally use credit cards to buy real estate. And the reason why is because I had a business that I knew my cost and my expenses, my financing fees, and all that sort of stuff. And I knew how much money I could make. Just like I don't know, here's a pen. Let's say if you got this pen, you could buy it for 50 cents. And you knew you could sell it for $1, but you could use a credit card to borrow the 50 cents. So you're out of pocket, maybe, let's say 75 cents, but then you could sell it for $1. Well, you'll make $1 or make 25 cents every single transaction. Well, you do that all day. Same thing with the credit cards. Now you're looking at your credit score, which is a good idea. You definitely want to think about that. But at the same time, don't get any credit unless borrow, I'll give you an example. Get a home equity refinance, you refinance, pull the cash out. Don't do that if you don't even have a business built. You're just going to have the money sitting in your bank account and you're going to be paying interest on it. I would not do that. I'd wait till the business was built the entire business. So then I now can borrow that money to then put that money into a property that's going to be making money. Like buy this now pen, because I now have this pen, I could buy it to then sell it. So I think it's definitely a great idea. If you know what you're doing, it's definitely an advanced strategy, because it can eventually, like those credit cards, 0% is great, but after 12 months, it jacks up to 12%, 17%, jacks all the way up to 20%. So you got to be careful with that. You want to be able to get out of that credit card by getting a refinance or a conventional loan, pulling that money back out to pay off that credit card.
We have another question. So he has questions about subject to deals. I saw another question about subject to deals as well. So he found a subject to deal in the Chicago area, and he's wondering, have you ever heard of assuming an FHA loan?
Yes, you absolutely can't assume any loan, but getting the bank to absolutely agree to it. So in subject to, what you can do is, subject to the loan that's currently existing on the property, you can call up the bank and literally tell them, hey, I'm going to take over the payments. Nothing's going to change. I'm just going to keep making the payments. A lot of banks they won't be happy with it, but at FHA, you're not necessarily taking over the FHA. You're just making those payments. So same thing with all mortgages now. Back in the 80s, you could do subject to, meaning literally transfer that mortgage over to the new person, like the seller, and you would come in, buy it from them. They would transfer that mortgage literally in your name. Literally everything gets transferred over. You can't do that anymore. Subject to is different now. It's different in a way that banks just want their money. They want to make interest on the money on top of that. And so what they do is they make sure that you are able to, sorry, I said a little wrong. As long as you're making your monthly payment that the seller was supposed to be paying, you could put your name on it, you could change all that sort of stuff. But as long as monthly payments being made, the banks aren't going to bother with you. In fact, I know a lot of subject to people that they love buying property subject to. And as long as they make the payment, The banks don't even care. They don't even bother with them. You know, a lot of us have heard of the due on sale clause. Well, that due on sale clause only matters if the bank says, hey, you're not paying me. Now we want our money back. So yes, you can with the FHA loan because you don't even put it in your name. You're literally just making a payment for them. You get the title in your name. This is how subject to works. You get the title of the property in your name. The seller signs over everything to you, and the mortgage is still in the seller's name, but you have all access to everything. You basically have attorney, power of attorney. That's what you get. You get power of attorney over that property, not the person, but the property. And then when you go and refinance it, you have the title, you have power of attorney, refinance it, then pay off the original loan. You have the property, hopefully no money down. So yes, absolutely you can.
Awesome. So we also have another question from Elton about real estate markets and where are some hot places to invest. Elton, would you like to expand upon that question?
Hi, Charles. I think you got it. So just curious to see if you can spend maybe 30 seconds, a minute, whatever the time that you have left, just to give us your perception, your understanding, or your forecast for some of the markets next year.
Really?
Like Georgia, North Carolina, I don't know, whatever comes to your mind right now.
Awesome. And glad you're on with us, Elton. So yes, I'm pulling up, give me a second. I'm pulling up Zillow right now. Zillow is usually one of my more favorite just because it's easy. It's not the most accurate, but it's fairly easy. And let me share my screen now with you. All right. So here's the screen. So if we're looking at Georgia, actually, let me back out. I'll go back into Georgia in just a second. So what I'm looking at is the properties in the market in general. They're now starting to cool off. Like the market was really hot the last year, like 2021 into 2022. It's been really, it's much harder for a lot of my students to buy properties. Now they still are, they just have to be much more aggressive in putting in offers. Like Charles was putting in like 3 offers a day, every single day. That's how he was getting lots of properties. But what we're looking at now, what I'm seeing for my students, so Tennessee was pretty good, right, Charles? Like we had, where were we at? Memphis was pretty good for a while, but now it's gotten a little hot, right? Charles, what do you think about Memphis now? I think, William, are you in Memphis too?
Yeah.
No?
So yeah, Memphis is getting very hot, and it's I remember I was telling someone Memphis is a great place to invest. It was like, and I was like, you can get so many properties under 100,000, and they're like, no, like it's not a lot, and I was like, you're crazy. I bought a lot of properties in Memphis, and when I checked it, sure enough, yeah, the prices have gone way up, but there's still a lot of other cities out there, and our students are finding these cities all the time, all of these little hidden gems here and there.
So I'll quickly walk you through what I like to do. So let's just say $100,000, one bath. So the minimum is 3-bedroom. I personally don't like 2-bedroom because they're really hard to rent, and I love renting to families. But 3-bedroom, 1 bath. Let's just start with there, and then let's just pick one anywhere here. I love looking at properties too, so let's just see how it's looking. So $56,000. I usually jump right down to how much we could rent it for. And remember, they're not the most accurate, so we're going to take it with a grain of salt. So let's see if they have the rent $900 a month. Man, if you could rent it for $900 a month, that's not bad. I mean, the property doesn't look all that great, which it might be a little off, but it could be okay. And here's the thing, Elton. Let me back out now. So Memphis got a little hot. I think it's kind of cooling off a little bit now. But what I'm looking at, literally all the Midwest, like all this area from Missouri all the way down to Louisiana. Texas is okay. It's still a little pricey, but all around here, like all these states, they're really good. Now, it's not necessarily an entire city's good. It's let's say Memphis. We're looking in here and we're saying we can find good deals even though they're not everywhere. Like in 2010, I didn't have enough money. Like I wish I had more money. I would buy so many more properties, but now it was harder then. But now I'm looking at, as soon as the market does change, then we're going to be putting in more aggressive offers, offering much lower. So like I said, I was getting them 50% off the actual price of what is, a couple of years prior. So here's what I'm saying. Georgia's not bad. I have a couple people also in students in Birmingham that are finding some decent properties here, but you can tell there are so many more properties on the market even longer. Like let's say even in Georgia, let's go to Atlanta. This city's kind of big there. Let's go out here. Without taking too much time, I'm not looking at Georgia very much. The only thing I think was it Birmingham? No, that was over here. No, honestly, Elton, Georgia hasn't been that good. What I've seen is Ohio. Students are still getting a ton of properties here up in Ohio. Indiana is also pretty good. Illinois, I stay away from Illinois. Tennessee is not bad. It's kind of pricey. This area has been really aggressively hit by other investors, but where they haven't is Ohio, getting into Pennsylvania, all this area up here. So if I were to be buying properties, if I were getting started right now, I'd be looking in this area personally. You're going to find a lot of good properties here, and then down getting into getting into Florida. Florida is going to have some good pockets of good homes. So it's not the entire state, and sometimes not even entire city, but you can look at specific little pockets of a specific city. Oh, quickly, I saw Laura said, why would I stay out of Illinois? Illinois is just really not the best for tenants, or sorry, for landlords. It's better for tenants. It's really, really rough. Like Oregon, I would never own in Oregon. Like in Oregon, a landlord even has to pay for their tenants to move out. It's silly. So it's very tenant friendly, which it hurts us as good landlords. We keep good properties. We make sure they're taken care of, take care of our tenants. The downside is when you have a state like that, they take advantage of it. It just gets worse.
And also, Cecilia is also saying, what about Detroit?
Ooh, Charles, you know about Detroit? Have you been looking there?
So I did look at Detroit one time. So Detroit, you can find a lot of properties under 100,000 in it. You just have to be careful which areas you invest in. And so, but you could, once you find a good property manager, as Dustin mentioned, always build a business first. So Detroit could be a good place to invest. I actually know some people who are doing very well in Detroit. So, are you going to Detroit, Dustin?
Yeah. So we have a few students who are investing in Detroit, and they definitely like Detroit. Now, back in 2009, it was really, really rough. Like you couldn't get properties, or sorry, they would pay you practically to take properties. Like it'd be like $1. So let me back out. I'll look at Cleveland. So Cleveland's a really hot area, but I would personally not invest in the city of Cleveland. I'd invest in the outskirts. Like I personally own, where is it at? Maple Heights, somewhere here. It's a smaller, like Shaker Heights.
Just down a little bit there, Dustin. Right there.
I am blind, apparently. I can't see it.
Right
here?
Go left.
Maple
there
Heights.
You go, right there.
There we go. Okay. So just like Detroit, I would not invest in here. In fact, a lot of my property managers, they don't have anything to do inside here. They do in the outskirts. So like Maple Heights, Bedford Heights, University Heights. So same thing my students are seeing in Detroit as well. Is that Detroit? Nope. Where is it back? There we go. Detroit as well. Like get to the suburbs, then you're going to have, but like Charles says, your property manager, they're the ones that are going to be making sure that you're taking care of everything.
Absolutely. All right. So now I'm going to say some of the questions. And so if I get if there's something you want to expand on, just let me know. I just want to make sure we try to capture as many questions as possible. So the next question is from Eugene. So he is asking when beginning to invest, should he start looking for multifamily or single family? He's currently looking at Baltimore City.
And this is Eugene. So absolutely, I would say yes to both. And the reason why I say that is because we go off of deals. Like we're real estate investors. Whatever we do as investors, we depend on the deal. I have a lot of students, they say, well, Dustin, should I get this or this or this or this? Or should I use this type of financing? Or there's always these ors. It doesn't really matter about like what you currently have. It matters on the deal. Like William, he has properties coming in, or not properties, deals coming in, like let's say a mobile home park or a storage unit or a single family home, whatever it might be. We're investors. We look at the deal to make sure that's going to work. Now, in the master passive income model, we look for buy and hold, and we try to make passive income from every single property. So that's what we're looking for. So multifamily, fantastic. Single family, residential, you have 4 units and below, fantastic as well. My personal belief, if you're going to go above 4 units, so 5 units and more, that's a harder type of investing, you have to get a lot more money as a down payment necessarily in general, but at the same time, different financing. It's a commercial loan. It's only 5-year loans. It's much more difficult. So I would stick with, personally, to start 4 units and below, but then also look at whatever deal comes your way.
Don't be afraid to learn about the other stuff too. If you stay too narrow, you're missing all the stuff that's happening out here. Don't miss it.
Which I'm going to give a shameless plug to RubeCon, the Real Estate Wealth Builders Conference. Hopefully you guys have heard of it. But I'm bringing all my friends who do all these different types, from land to apartment complexes to storage units to Airbnb. Like, I'm bringing all my friends, and we're all going to be teaching on how to do this sort of stuff. So you're going to find other great investors, experts that are genuine, that just want to help. They're going to be there as well. So you definitely need to come. Hopefully you guys are going to make it to RubeCon.
Awesome. Yes, we definitely hope that you all come to RubeCon. And the next question is something we actually talked about at RubeCon, can I purchase a deal zero down? So Tanner West is asking this question. So I'm going to help with this question because Dustin have taught me that so well. So to cut a long story short, I bought two deals when Dustin coached me early on. And I was out of money, and I asked Dustin, what can I do? And so we strategized, and we came up with using private money and hard money. And so you could absolutely purchase deals using nothing down. So Dustin talked about a number of the strategies on this call. So seller financing, you could strike a deal directly with the seller. And in some cases, you don't have to put money down. You just set that agreed to a payment. So subject to, you could also do nothing down deals with subject to, because you're assuming the other person's mortgage. And so you could strike a deal where you could make a win-win situation between you and the seller as well. You can use private money as well. And private money is so great. I love using private money on deals where you can go to an individual and borrow the money rather than going to the bank. And so the key thing is so many different strategies, and we talk about them at RubeCon. We talk about them with the group coaching, the membership that Dustin mentioned as well. But the key thing is make sure you focus on the seller. Don't make it about yourself, or focus on the person who you're working with to structure that nothing down deal. Try to solve their problem. Try to figure out what do they want, and how you could make a win-win situation with that deal.
Absolutely. That's a great point. And Charles, like I said from the beginning, Charles is phenomenal at private money. And so honestly, in 2023, 24, it's going to be amazing to get no money down properties, because people are just going to be getting out of these properties, especially when you have sellers that have a decent interest rate. You can do really, really well. So you just got to learn these tactics and the ways to invest. And obviously, we all teach those things. So yeah, next question. While you're asking the question, I put in the chat, I would love to see everybody come. I want everybody to get 10% off. Use the promo code Dustin. If you go to RubeCon.com and you can use the promo code Dustin, I'll give you 10% off. I just want to see you change your life by investing in real estate. And you'll be amazed at how many awesome people are in this community of real estate investors. And you need to be a part of it. Especially, this is going to be the best time to invest. You absolutely need to be there.
Awesome. Hope to see you all at RubeCon. So next question is a quick question from James. He's wondering whether it's $219 or a month for the Wealth Builder. So it is $219 investment each month. Great program to be a part of. And as Dustin mentioned, if you sign up with the promo code 2023, you will be able to get $700 off. So definitely take advantage of that. So the next question, Dustin, is from. Yep. Thank you. So yeah, definitely I'll look at the screen if you need more info on that. So the next question is from Tanner. So he is asking that. So he is trying to start his business by finding a PM. So he's wondering, how do I even know what location or home do I qualify for?
Oh, okay. So Tanner, definitely there's like, that question seems small. There's so much inside there. It really comes down to building the business, really what it comes down to. from finding the right people that are going to manage the property. But first, before that, finding the right area of the country to invest, finding the right property managers in there, like the cities, find the property managers, find the mortgage brokers. And then from there, having the mortgage brokers and property managers figure out the best way for you to invest, from financing to which area of the city is best to invest in. So that's what we talk about in the everything at the Real Estate Wealth Builders community that we have, the membership. So definitely you need to, honestly, you need to join. But the biggest thing is building the business, finding the right inventory. City app gives them good inventory. Then find the right property manager. This is literally in order, step by step. City with good inventory. Property manager that's going to manage your property well, that you can trust. That's not going to be, stealing your money and actually call you back. Mortgage brokers next, then inspectors, then insurance agents. And so from then on, we just keep building the rest of the business, but they're the ones that do all the work. So that's what you want to do, is have the experts help you make sure you're doing it right.
Awesome. Thank you so much, Dustin. And the next question is from Chris Kelly. So Chris Kelly is wondering, how much attention should you focus on the local economy? For example, he's saying in West Virginia, they have good prices, but the unemployment is high.
Totally. So here's the thing. Every realtor will tell you, and we have all heard this saying, location, location, location. Well, that's for home buyers. We're investors. We don't care about location, meaning people have to live somewhere. Now, I get it. West Virginia is definitely, there's not certain areas that don't have people flocking in. Same thing with like Ohio. Ohio doesn't have a lot of people flocking in there. I mean, it's freezing there. It gets really, really cold. But at the same time, there's not a lot of big industry and all that sort of stuff. Here's what I view, and I've been investing since 2006. In fact, the first place that I started, I'll tell you guys the city, and I will encourage you, don't invest there because it's really hard to find a property manager. I've since then have sold a lot of properties because it's a really, really economically depressed. And the reason why I say this, Chris, is because similar to other areas of the country that have really economically depressed, like people don't have jobs and all that sort of stuff. So this city is called Youngstown. Youngstown is a very, very rough city. You'll find properties like I bought some houses for like, $15,000. Now they're worth like $60,000, which is great. That's a lot of money. But I'm currently trying to offload them because it's an economically depressed market. I'm doing some of them rent to own, which is great because I'm actually helping the people there. Homeowners take care of their neighborhood. They take care of their street. So I'm doing a few properties rent to own. Now looking at the labor market, yes, that's definitely something you take into account. I personally look at it, but then at the same time, what it really comes down to, people have to live anywhere. So if you're looking for appreciation, you look at labor market because more jobs, prices go up. If you're looking at passive income like we are, you don't necessarily need, it's good. You want to look at it just to see if it's dramatically like it's bad, then might stay away. But on average, because we're going for passive income, it's literally just the same money circulating inside that same city over and over and over again. It's sad, but there are good places to invest. You have to, like Youngstown can be a good place to invest as long as you have the right people in there. Like I still have the right people in there. So my same property manager, been with him for 20 plus years. He's been fantastic, but he's the only person that I would really trust in that city. So I'm not buying any more there. Same thing with like West Virginia. It could be bad, but your property manager is going to tell you, hey, this is a good place or not a good place.
Awesome. Thank you so much, Dustin. Alexander, first up, he's saying he want to DJ at the Fiesta at Rubicon.
He wants to be Alexander. Well, we'll have to talk, man.
Oh gosh. So, but he also asked another question. He asked if you're looking to purchase a property with the lowest amount of money down, would you recommend FHA versus a conventional loan?
Oh, totally. Okay. Nuance with the FHA. I love FHA because it's 3.5% down, which is great. The nuance is you are stuck with the PMI, the private mortgage insurance. Like you're going to be stuck with $150 a month every single month. Like even if you get below 80% loan to value, if you still have an FHA, it's going to be stuck there. It's permanent. Like if you just have a 30-year loan for FHA, it's fixed. But what you do, if you're smart, what you're going to do is refinance out of that FHA loan into a regular conventional loan. When you have that, when you get to 80%, then that PMI goes away. So I think getting the lowest amount of money out of your pocket. Yes, FHA loan, but at the same time, you're looking at the PMI. You have to tack on, let's say $100. Talk to the mortgage broker, your experts that you hire. You talk to them about how much the PMI would be, because it'll be stuck every single month until you refinance, and then hopefully that'll go away. But yes, that's really good. Now, I will say, I have mortgage brokers, in fact, inside of our student community. So if you join our student community, we have lists of mortgage brokers. I have mortgage brokers that do 5%, 10%, but they're not FHA loan. And so I was talking to my mortgage broker recently. I said, what's the lowest you can give me? He said, I can give you 5%. It's like, 5% down? Okay, that sounds great.
Awesome. Thank you. Thank you so much, Dustin. So we have another question from Gerardo. He's asking, is there a one-time full price for lifetime access to the wealth builders?
Oh, yes, there is. Yes, there is. So I don't have that link on me right now. So yes, there is. I can't remember what it was. So I'll have to find it. But yes, there is the lifetime access. So who was it again?
That was Gerardo at Arias.
Got it, Gerardo.
Yep.
I'll send you an email. I think I have your email, or at least because you registered, I'll have your email. I'll send you an email with that. I probably once, maybe I'll just send everybody an email thinking everybody be on and give you a couple links for all this sort of stuff. But then I'll also put that in the email as well. If you want to join Lifetime, where you'll literally get access to it the whole time. Totally. Yeah. I have a number of Lifetime students. They love, they love the Lifetime because it's just great. But anyways, yes, I'll send that out.
Sweet. Awesome. Laura is asking, what percentage of the MPI students invest from a long distance?
Yeah. So Laura, I put it in the chat there. I would say about 99% of them. I literally have maybe one or two that really want to invest where they are, because where they live, they have really good properties right around them. So use the same business model, the same idea of getting property managers and all that great stuff. So, but I would say literally 99% of the students invest out of state. And the big reason why is because we don't necessarily live in the best area for investing. Like I live in Peoria, Arizona. Prices are so high. Like my house, it's one of my rentals. I literally live in one of my rentals. We're going to buy a new one. That's why I was looking for mortgages recently. But in this house, I think it's $350,000 for this house, and I could rent it for maybe $2,000. And so I was like, oh, that's not going to be good passive income. So we got to go out of state. So yes, we mostly invest out of state.
Thank you, Dustin. And so that was all the questions I got directly. Do any